In today's video, I want to look at a possible scenario that could play out here in the next month or two. So we've got one really long, really stretched intermediate cycle here from May into the yearly cycle low in December. That stretch was generated by the intervention in the stock market on election night. That turned the stock market back up. Took the dollar up with it, stretched the dollar cycle, and it forced gold into a very stretched intermediate cycle. Quite often, a short cycle will follow a stretched cycle. So I'm keeping an open mind here. There is a possibility. I've been saying that this looks like gold, and especially miners, are in an intermediate decline. But there is a possibility that that intermediate decline will terminate quickly, simply because we're probably due to have a short cycle to even out the longer term cycles after this really long stretched intermediate cycle. So we've got a support zone right here at the May intermediate cycle low at about 1200. On Friday, gold dipped below that level and then popped back above it. An undercut low. I've gone over those before. If this, I think there's a good chance this is going to turn out to be at least a daily cycle low. My original expectation was that and probably still the best odds anyway, is that this will be like a dead cat bounce. Maybe it'll come up, rally, just far enough to, maybe above the 50-day moving average, probably just far enough to push the 5-day RSI to where maybe it tags this overbought level, and then we come back down and make a final intermediate cycle low in late March or early April. That's kind of been my preferred scenario, but I'm not going to rule out that maybe we put in a short 12-week intermediate cycle to balance out this really long cycle that came before it. And here's what I think is going to drive it. So if I look at the dollar, you can see we've got that same really long intermediate cycle that was rescued by the intervention in the stock market on election night. Barring that intervention, the dollar would have continued down along with the stock market until both found their intermediate cycle low in their normal timing band, which probably would have been towards the end of November. The dollar would have likely moved below the May low, but that cycle was stretched and extended by the intervention in the stock market, so we ended up with this hideously long intermediate cycle. Now, this is where it gets a little bit complicated. We got a daily cycle bottom that marginally broke below the December low. That was an indication that the intermediate cycle was then in decline. But over the next, I believe this was 21 days, the dollar rallied, forming what appears to be a right translated cycle. That would indicate that this was a larger degree bottom, an intermediate degree bottom, and that the dollar has started another intermediate degree advance. But on Friday, the dollar has closed back below the 50-day moving average. So I'm now starting to question a little bit whether or not this really is an intermediate degree advance. We're going to know in the next couple of weeks if the dollar continues down, and it did break its daily cycle trend line here on Friday, so it would appear that the dollar has started a daily cycle decline. So I'm going to keep an eye on this. If the dollar, if we have trouble on Wednesday, the debt ceiling does not get raised, then the dollar is going to take a beating in the weeks and months ahead. And the history has been that every time the Fed has raised rates, the dollar has declined. So, you can see back here in December of last year when they raised rates, we got a brief little pop, and then the dollar rolled over into an intermediate decline. Again, this year in December, they raised rates, the dollar had a brief little pop, and then went into an intermediate decline. They are almost certainly going to raise rates again next week. The pattern, if it holds, that should trigger an intermediate decline in the dollar. If we, again, like I said, if we have trouble with the debt ceiling, if that hits a snag, then that intermediate decline is going to become severe. So I'm watching this. It's possible that this maybe turns out to not be a right translated daily cycle, and this is not the beginning of a new intermediate rally, but this is just another kind of stretched cycle. It clearly did not make a higher high, and it could be set up, if things don't pan out perfectly this week, it could be set up to break this low, and then we could start the journey down into that 3-year cycle low that I've been looking for sometime in 2017. And here's the other side of the coin is the euro. Now, if the euro is rallying, then the dollar should be falling. They move inversely to each other, and the euro makes up the biggest percentage of the dollar index, so they rarely move together. So if I look at the euro, we've clearly got an intermediate and a yearly cycle low right here. The move into the daily cycle low came nowhere near breaking this low. And now we've started a new daily cycle here, and it's still very young. It's only on, I believe it's either day 5 or day 6 on Friday. So I'm watching this also. If the euro continues to rally and makes a higher high, it's going to indicate that the intermediate cycle is still advancing in the euro. And here's another indication. I noted before that in the advancing stage of an intermediate rally, price doesn't stay oversold very long before it bounces. And you can see that's what's happening here. So if we continue to rally, we're going to push price up into this overbought area, and it will, it could continue to stay overbought, which is an indication of an advancing intermediate cycle. So that's what I'm going to watch over the next week or two, and see if the euro does come up and break this top. That's going to indicate that the euro is still in the advancing phase of its intermediate cycle. It's going to indicate that the dollar did not start a new intermediate degree advance, that it is still dropping down into its intermediate and yearly cycle low. And then at that point, I think the euro would control the currency cycle. So for as long as the intermediate advance continues in the euro, the dollar will continue to decline. And if that's the case, then it's very possible that gold completed a short intermediate cycle decline on Friday, and then I would have to modify my strategy. My current strategy is just to wait for what I was expecting to be kind of a very temporary bounce, and then one more leg down into the intermediate bottom in April. But if I get the feeling that the currency, the euro, is going to control the currency cycles, and that the euro is still advancing and the dollar is still declining, then I'm going to have to change that strategy and try to get back in under the assumption that gold would follow the euro up and continue up until the euro completes its intermediate degree advance. So next week could be important, and the vote on the debt ceiling could be extremely important. If that hits a snag, then that is going to be what will drive the dollar down into that 3-year cycle low this year.